Hey, Rich Hillo here, Straightforward Wealth Management. It's been a good day. Got my adult beverage. Why don't you grab one? Maybe a cup of coffee. Let's have a chat about accounts. Sad had an account conversation with a client. I start every meeting kind of that way. We talk about you and your life. And people wonder why I'm talking about the different types of accounts. Well, it depends on when you want to use them. I've got $30,000 extra. What am I doing with it? Well, I want to invest it. Why? What's it for? Is it retirement 30 years from now, 20 years from now? Is it for the RV, maybe the vacation house, maybe educate a child? The type of account you put it in matters. Specific accounts, the most common. You've got your work 401k, simple IRA, if you're a government agency 457, nonprofit 403b. These are all IRS codes, but basically it's retirement plans for different types of entities. But you have to be an employee there someplace, whether you're the business owner, you're technically an employee, or you're an employee to participate in those plans. Outside of that, you've got a couple of retirement plans, the traditional IRA and the Roth IRA, and then you've also got a traditional non-retirement account, the 529 account for education. So let's talk about those personal things. The 529, it's a Roth IRA for education. Well, basically you can use it for any school, any accredited school, kindergarten through post-secondary college education. Comes out penalty and tax-free. In some states you get a tax deduction. Again, check with your tax preparer and make sure it's the right way to do it. But that's if you're having a conversation with your child about where they're going, not necessarily if they're going. If you want to have that conversation about if, maybe a Roth IRA is better for you. You've got the traditional IRA, the Roth IRA. Traditional IRA is pre-tax. Roth IRA is after-tax. Traditional IRA, you put the money in now, you get a tax deduction. When you take it out after you're 59 and a half, there's taxes associated with it according to your income. If you take it out before 59 and a half, they let you pay an extra 10% bonus penalty. The Roth IRA is after-tax money, so you don't get a tax deduction. Put the money in, take it out anytime you want, tax and penalty free. It's the money you make that if you take it out before you're 59 and a half, that you pay taxes and penalties on. Now, for both the IRAs, there are exceptions, hardships. IRS has made some different rules and things like that. And again, those are all things that we discuss as to what it is your goals are. Those will be in more detail in another video. The non-retirement account is just a traditional investment account. It's like a glorified bank account, except instead of just being able to have cash or checking or a CD, you actually can have investment stocks, bonds, mutual funds, that kind of thing. Each one of them have their advantages. Traditional IRA, you get a tax deduction. Roth IRA, it comes out tax-free. A non-retirement account, a traditional account, basically has taxes associated with it when you make money from dividends or interest, or you make money on an investment, you pay capital gains, maybe less strings attached, but you're taxed along the way. And each one of them has its advantages again and its disadvantage. Well, that's just kind of a quick overview of accounts in general, and you can see each one of them has its advantages and disadvantages, and if you talk about what your life's goals are, you can see when maybe you want to do something in one account versus another. I hope that was helpful. Until next time, cheers.